and welcome to Ask Athena Anything, your trusted source for insights into the South Florida real estate market. I'm Athena, your local realtor, and today we're addressing two really pressing topics: the current state of the mortgage rates and the effective financing strategies for home buyers, which means creative financing. If this is your first time to the channel, go ahead and subscribe so that way you have the most updated information. Joining me today is Greg Warehem, a seasoned loan officer with the Federal Savings Bank. Welcome, Greg.
Well, it's a pleasure, Athena. Thank you for having me today.
I love having you. But let's begin with an overview of where the mortgage interest rates stand today. It's a hot topic with buyers, as you know.
A lot of times timing is everything. If we had a conversation a week ago, it's different than the conversation that we're having today. So, what we've seen in the market over the course of the past several days is we've seen a pretty sharp decline in mortgage interest rates. Now, that's not to say that they've declined back into the fours and the fives as of yet, but we've certainly seen a 0.5% reduction in a very short period of time. As we continue to watch the market, we're currently at the lowest level we've been since the very beginning of October of 2024. So that's great. We're at a 6-month low right now, and things continue to seem like they're dropping.
I love that news for buyers because they have been sitting on that proverbial fence waiting for some good news. So hopefully, a 0.5%, that makes a big difference in a buyer's overall monthly payment, right?
Well, sure does. It's all relative to loan amount, but if you'd entertain me for a quick example, we could talk about the difference. So
Yeah,
let's just
let's
use
do it.
a $600,000 mortgage. So if interest rates drop 0.5% on 600,000. The difference in monthly payment is, drumroll please.
There you go.
So that's almost $200 a month, just shy of $99 a month. Now and that's on a $600,000 loan. So the bigger the loan amount, the bigger that increase as to what the monthly savings is. And that's all interest. So it's really a gift to us right now from the market to purchase a home with these lower interest rates that we're currently in. You can save some money on a monthly basis, and also opens up an opportunity for people that may have closed last year where the interest rates are in the sevens, chance to refinance and drop that payment.
Yeah, $200 on a $600,000 loan is significant. I mean, that's a significant amount of money. You can put that toward childcare. You can put it toward anything, maybe your car loan or whatnot. It's a significant amount of money for a lot of homeowners.
No question about it.
Yeah.
It's certainly moving in the right direction.
I love it. I said, let's keep it coming down. We're going to talk a little bit later why that may not be true as we look forward into some of the more macroeconomic impacts that we have out there. But overall, what has contributed to the higher interest rates or rates stabilizing between 6 and 7%?
So, it's really interesting how fickle the market can be at times. So you really initially, especially with tariffs that are rolling out there. So there's a couple things. There's economic policy, as I think we talked about the last time on the call, but there's also things like the tariffs that are going on currently. When you look at the overall economic policy of the Fed reiterated today they're not planning on continuing to drop interest rates because there's a fear of some continued inflation. Some of the inflation indexes that came out last week showed inflation was a little higher than expected, but it's still annualized at 2.8%, which is significantly better than where we're at a few years ago. And it really gets us closer to that 2% strike rate that the Fed now has been talking about for several years. So it's moving in the right direction, and their policy will sway it. The other thing to pay attention to is what's going to go on with these tariffs. I mean, we slapped China with a 34% tariff, and I'm not here to qualify it one way or the other.
We want to talk about what happened yesterday or the day before. I'm 1 day short. What happened the day before yesterday on what they call Liberation Day and the day the tariffs went in? Talk a little bit about what the effect has been from the other countries, and then how is that possibly going to impact our mortgage or our real estate industry. So I love the fact you're willing to dive in on this subject, neutral, free of politics.
So I think China's always a great place to start because historically there's been a somewhat of a trade disparity at times with China. So it's 34% tariff that we had imposed on China, which we get a lot of our disposable goods for, to include construction material, uh, and a lot of other products that we use in this country. Now, China's response to that is they slapped us with the same tariff, saying, all right, we're going to do the same thing for you with 34%. Let's look at it specifically for real estate. So, goods that you're receiving from China, they're going to go up in cost, right? Because at the end of the day, China's not going to absorb all of that cost. That's because some of it's going to be transferred to the consumer. So the cost of lumber, if it's coming from China, or let's use drywall, because a lot of it does come from there. Cost of drywall is going to increase. Well, cost of drywall increases, the cost to build a home increases at the same clip. Now, could it create some supply chain disruptions? It could. I mean, the good news is we still have the raw materials, unlike during COVID, when raw materials were just hard to access because everyone was in lockdown and confined to where they were at. But we could see some potential supply chain disruptions, which also forces up the price of things. It's supply and demand, right? Not enough stuff coming in. The price of the stuff that is coming in has a tendency to go up. And it could lead to some higher inflation as well, housing inflation specifically if the cost to construct a home or renovate a home is increasing. So those are definitely some things that we're going to have to pay attention.
Oh, absolutely. I was reading in the US News Mini report is that the average cost of home is to build is supposed to go up approximately on average 9,200. So these tariffs do have a direct impact, like you were saying, Greg, on building materials, on drywalls, on anything that we import in order for a construction to move forward. $9,200 may not seem like a lot of money, but it is a lot more money that everybody has to be able to contribute to in order to build that home.
And the interesting thing is it never seems like it's a direct dollar for dollar comparison as to what it's costing the construction end of it relative to what the property is selling for. There always seems be a little bit of a float in there. So if the increase in cost is 10,000, does that mean the price goes up? The price goes up 10,000? Not necessarily. There could be a multiplier in there. For that
Yeah.
additional 10,000, does that increase pricing higher than that
Yeah, and
number?
then we look out, how new construction is, completed. They're completed in phases. And we always know that as the phases continue, the price goes up. But when you speak about that multiplier effect, who knows what, phase two, phase three, phase four is really going to cost as we look down line on some of this new construction bill.
Yeah, no question about it.
Yeah, it's fascinating. Well, it's something we're all going to have to contend with. We're something we're all going to have to learn, and we're all going to have to be able to look to our lender and our realtor to give us advice on how we navigate this ever-changing environment.
Yes, certainly. And what's going to be interesting with the tariffs going back to the short-term impact on interest rates is it's actually been a positive thing as it stands today for interest rates. What's going to be interesting is are the tariffs a long-term solution or are they short-term? And we see this dip in the interest rate market. Well, we don't even know what next week's going to bring. What we do know is it's volatile right now and it's very reactive. Have an inverse correlation with the market or a direct correlation with the market. When you see the stock market dropping, generally means 10-year treasury bond yields dropping. And in addition to that, longer term interest rates are dropping as well. And that's what we're seeing.
Yeah.
So don't be alarmed with the stock market going down because unless you're pulling your money out tomorrow, we know long term that that's going to increase at a percentage. Let's look at the positive, the advantage of the lower interest rates, and see if we can make housing a little bit more affordable, at least in the short term.
So let me ask you a question. Given all of the dynamics you just spoke about, would you advise buyers to purchase now or wait?
It's always the right time to buy.
Said from a true lender.
It's relative, right? So
Yeah, it
that's my
is.
knee jerk answer. But it depends on how long you plan on holding the property for. So if you're planning on a short-term solution to buy a house and you plan on being in that house for a year, 2 years, you really need to evaluate that, make sure it's the right decision for you. But if you know that you're going to hold on to that house for 5 years, for 10 years, it's always a good time to buy because we know long term that real estate is going to appreciate at about 4% per year. And that's what all the data tells us since 1991. That's the appreciation. Even with the huge decline in 2010, it's still appreciated at 4% per year on average, factoring in the decline and the massive increase in
I
short
was
term.
going to say, don't forget the unicorn years. So we have these outliers, but you're absolutely right. Appreciation in real estate somewhere always between that 4 and 6% mark, and that's the real number to look at, in my opinion. But what do I know? I've only been doing this for 23 years.
Well, too, Athena, it's the rent. Like that's the thing that we lose focus on too, is at least you can control things
Hmm.
from a mortgage standpoint. Like, hey, I got my mortgage, I bought the house, here's what I paid, here's what my payment is. Well, we know the property is going to appreciate 4% per year on average. There's certain tax implications that could benefit you positively with that disclaimer of I'm not an accountant, but there usually are some advantages that you can take. So there's a lot of different things that can go into play that can help someone as the consumer or the home buyer. So these are kind of the things that you have to pay attention to, and also have to pay attention to rent increase. What's outpacing the appreciation right now in real estate is the appreciation in the cost to rent. 4% real estate appreciation, more than 6% increase in rental appreciation during the same timeline. So, it depends. So that reinforces to me why it's always a good time to buy, unless you have some just a short term need you're trying to adjust for.
No, I agree with you. It's always the right time to buy, to use your line. And the reason is because we don't know what's ever going to happen with the market. We can look backwards, we can try to look forwards, but what we have is today. And today we do have lower interest rates as far as what we've seen historically over the last 2 years. So it is a great time to buy. It's a great time at least to have a meeting with your lender to see what your picture would look like financially in moving forward. But Greg, I want to talk a little bit now about creative financing because, it is hard for buyers right now. Home buyers are concerned about the economics. We just talked about the tariffs. How is that going to affect them? Tariffs affect big business. Big business affects employment. So, we have a lot of buyers with real concerns. And creative financing, as we like to call it, gives some options that aren't like standard options when you go to apply for a loan. It's something that you strategize with your realtor and your lender to see how can I pay less than what the going rate is without, calling around and doing the round robin dialing of lenders and what's your rate. So let's dive into some creative financing. I know you wanted to talk about three specific ways a buyer can look to their mortgage lender to see how we can create a strategy.
So I think that a good place to start is always with interest rate buy downs, either whether or not that's a short term buy down or a long term buy down. Short term buy down means that the rate is temporarily reduced for a period of time, 1 or 2 years. And then a long term buy down, that means you've driven your rate down. It's going to stay at that level if it's a 30-year fix forever on the mortgage. So let's use an example of purchasing $1 million house and say that there's $20,000 in credit that's coming back from the seller. There's an issue with the property, minor issue. They're going to issue us a $20,000 credit, which isn't that big of a number if you look at the $1 million price point. Well, you have a couple options. You could reduce the purchase price of the property by $20,000. But that doesn't really save you a lot of money on a monthly basis. So let me do the math for you really quick. I'm going to round the numbers, about $100 a month difference in payment. But if you took that $20,000 and you used it to buy down your interest rate, well, now if the interest rate market is at 6.5% and you can get down to 6% on $1 million, that's going to change your payment by another drum
Another
roll.
drum roll?
Oh, I love them. Ooh, and I'm gonna have to move to these as well. Let's see, 20. That changes your monthly payment by $325 per month on a
Whoa,
million.
whoa, 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 whoa. Let's just stop right there. I want everybody to hear what you just said. So, a $20,000 credit from the seller to the buyer. Again, you were talking about maybe there's some repairs or whatnot. So, they negotiate $20,000 credit. They can go ahead and reduce their purchase price. And that would save them, you said, about $100 a month.
Yep.
Or they can take the same $20,000 they're getting from the seller and buy down their interest rate and save how much?
They could save $325 if the rate comes from 6.5 to 6%, as an example.
That is incredible. How many buyers come to you, Greg, and say, I want to buy down my rate? Not too many, right?
Yeah, well, yeah, it really comes down to, those are the types of things, Athena, that we talk about. We bring it
Mhm.
up to say, hey, here's the options that you have to look at. Buy down the rate, 325 a month to save you, take the reduction in price. And there's no wrong answer. It really comes down to the individual needs of the home buyer and what they're trying to accomplish short and long term. But a lot of people would look at the 325 and say, well, it's $325 a month. I want my 20 grand. Okay. Other people would say, gosh, $325 a month, well, that really makes a difference for me from a budgetary standpoint on a month to month basis and go that angle. So there's no right or wrong answer. It's about understanding what you can and can't do and what the options are for you and your potential family and making the right decision.
Well, that's the beauty of it, though, right? That is the beauty, is to be able to give this creative financing option to a buyer. And you're absolutely right. They might say, I need the 20,000 because I wanted to do X with the house as soon as I buy it, right? Something they wanted to do. Others are like, oh no, I don't want to pay that much more money to the bank. I can take that money and use it for something else in my, in my planning, in my budgeting. And so I think it's a beautiful option. Actually, with the interest rates at 6 to 7%, it's the number one thing we talk about when I'm doing a buyer initial call. Is we're going to talk to the lender and we're going to talk about buy downs, and if you get seller credits, if you want to do it on your own. And we put that right there into the strategy, so we remember to go back to it and evaluate which makes more sense for them. But I have a question for you right now. Temporary buy downs. Tell us what the beauty and the advantage in today's market is about temporary buy downs.
So what a temporary buy down is let's just say rates are at 6.5 and you did what's called a 2-1 buy down. A 2-1 buy down means in the first year, the rate that you would be paying isn't the 6.5, it's 4.5%. At the end of that first year, it goes up 1%, it's 5.5%. And then at the third year, it goes back to the 6.5%. Now, when you look at the potential savings in something like that, and let's just look again at that $1 million loan amount, because the numbers they're big, going from 6.5 to 4.5%. Your difference in monthly payment, whoa. Let me double check this because
Okay,
this has,
double check that number before you share it.
wow, that was a big number. All right, so 6.5%, your principal and interest on that is 63.20 per month. At 4.5%, it drops to 5,066 a month. So 63.20, verified the numbers, it's $1,250 per month differential in payment. Now, in
Wow.
that second year, when you go up to 5.5%, so 5.5%, payments 56.77, 63.20 at 6.5, 63.20. That saves you $642 in that second year.
Those are big numbers, Greg.
Huge numbers. When you add all of that up, 15,000, it's about $22,000. So they're
In
big numbers
savings. Yeah.
in savings.
In savings. Because what we're really doing is hedging against the market in a 2-1 buy down. We're saying,
Mhm.
okay, maybe in 2 years we'll let the market settle, and it's going to be less than what the original interest rate is that I entered into this contract. Is that not correct?
That's correct. And one of the really interesting things we're going back to really the seller paid for that, right? To
Hmm.
drive that interest rate down because the cost of that is what you're saving. But it's not as if you refinance that mortgage when the rate goes to 5.5% and rates drop lower, you don't lose the money. The money still comes back to you. So it's not as if it's hey, we're throwing this up to the interest rate gods to see what happens. No, it's calculated decision making to leverage money the seller may be giving you to the best of your advantage and to the best of what's in your best interest. I use the word
Absolutely.
best a lot of times in there. I think I used it like four.
But it's true. It's the best. It's the best option right now in this market. If it works out if it works into your strategy, it is a phenomenal secret. And I love the fact that you were able to explain it so well. So thank you for doing that. And it is
Of
my
course.
favorite. Another one, though, I do want to get into the second secret of perhaps some creative financing, and that's the adjustable rate mortgage. Can you talk to us a little bit about that and how it could be a benefit?
I certainly can. When you look at the purpose of an adjustable rate mortgage is to give you a lower interest rate for a fixed period of time as compared to a regular traditional 30-year fixed mortgage. So I'll give you an example. Just talking to someone this morning about this. So they were interested based on the nature of their work and the fact they're probably going to relocate as I'm probably only going to be in this house for 5 to 6 years. Okay, so let's take a look at what a 7-year adjustable rate looks like. Here's the rules on a 7-year adjustable. Your rate is fixed in for the first 7 years. After that, the interest rate can go up. And there's caps on that. So it can only go up they operate a little differently. So some of them operate where in that first adjustment period, year 8 rate can go up 2% and then adjust every 6 months as much as 1% with a cap of say 5%. So, but then there's different products that handle those adjustments in different ways. My point being, for this particular consumer, the interest rate was 0.3% lower for them, and it was a big mortgage. It was about $1.2 million mortgage. So for them, they looked at it and said, "There's no way I'm going to be in this house in 7 years. So if I'm not in this house for a 7-year time frame, why wouldn't I take that lower payment for guaranteed for that 7-year time frame?" And as a backup plan, as we all know, never is a long time. Hey, if I was in the house, I'm also running the hedge that interest rates are going to drop where I could potentially refinance that in that 7-year window without any type of prepayment penalty and get the interest rate lower anyway. So the most important thing about an adjustable rate mortgage is you got to understand how it operates. And it also has to be a product that in your mind's eye, you're figuring out how you're going to work with this short and long term. So between whether or not you're selling the house or what happens in the event rates never come down. And where would I be in year 8 when that interest rate adjusts? It's a great product for the right consumer, but it's not the right product for every consumer. But you need to
No.
understand your options.
No, you're absolutely right. You don't want to, if you're someone who's going to say, I'm going to raise my kids in this house, I'm going to have 3 kids, I'm raising them all, I want to stay in the community. ARM is not the right product for you right now. But if you're relocating, if you're thinking of retiring, if you're thinking of buying up, buying down, if you're planning on making a move, maybe you want a condo out on the beach in 5 years instead, well, this could be a good product for you. So, as Greg says, we have to understand it and it has to be part of our strategy.
Couldn't agree with you more.
Yeah, no, that's great. I love it. You had something, go ahead, add on. I love it.
No, I was going to shift gears over to kind of the third bullet point.
Yeah, let's do it.
So the third bullet point on that, which could be creative, is an assumable mortgage. So what does assumable mean? It means that you can take over the mortgage that a home buyer currently has on their property. Now, what's the advantage of that? Well, maybe they're at 3.5%. Maybe they're at 4%. And can you just take that mortgage over and assume it? I shouldn't say product, that possibility does exist. But here's what's important. Generally speaking, the only mortgages that are assumable is if the current homeowner has a VA mortgage or an FHA mortgage. Conventional mortgages generally are not assumable. So it's something to keep in mind. And what I will say specifically about a VA, a veteran assumable mortgage, is you do not have to be a veteran or active duty to assume that loan. Just the original homeowner that owns the property had to have VA benefits when they purchased the home, which is great. Great quick success story. I had someone who was looking to purchase a house in Belmar, New Jersey, $2 million property. The homeowner of that property was a veteran and they had a VA mortgage. The interest rate on that mortgage was 2.875%.
Oh my goodness, you're getting the house for free, Greg.
It was like $1 million mortgage.
Goodness.
Yeah, a big number. Now, at the market at that point in time, I mean, the interest rate was still going to be close to 7%. It was only a couple of years ago. So, as Athena and I both do with any client that we're dealing with, just trying to lead them down the right path. So I'm not going to do a mortgage for you if you can assume the VA mortgage. It's just, it saves you too much money on a monthly basis. So you coach them as to what they need to do. So what do you need to do? You really need that current homeowner that has the mortgage to reach out to their lender, their loan servicer, who they're making their payments for, to understand what the terms are to be able to assume that mortgage. Because just because I show up and I want to buy the house doesn't mean that existing lender is going to allow me to assume the mortgage. They're still going to want to understand credit. They're still going to want to understand income. They're still going to qualify you for that mortgage. But if you can do it and it's the right opportunity, always a great way to go.
Absolutely. And here in South Florida, we have a lot of veterans in South Florida. So the possibility does exist. So thank you, Greg. Those were three great secrets on creative financing in today's market. And let's move on to some FAQs. And we have five of them. I'm going to ask the question and you're going to answer. Are we ready to go?
I'm ready. I got the
Okay.
Karnak, Johnny Carson. Oh no, you may not everyone may
I
not
got
know
strap in. These are big questions. Oh my goodness. Okay, number one. What is the difference between a fixed rate and an adjustable rate mortgage?
Fixed rate means that you are fixed for the entirety of that mortgage. So if it's a 30-year mortgage, fixed interest rate, the interest rate will never change. Adjustable interest rates are only fixed for a certain period of time defined in that mortgage itself. So there's 3-year adjustables, 5, 7, and 10-year adjustable rates. There's some 1-year adjustables as well. But generally you see that somewhere between 5 and 10 years. When that adjustment period is over, let's call it a 5-year adjustable, adjust after year 5, the interest rate can go up. It's something to be aware of. That's the biggest difference.
Great. Okay, here's question number two. How do I know if an ARM is right for me?
Education.
Mm,
Education and great dialogue with your real estate agent and your mortgage professional, that they understand what your short and long-term needs and goals are, so they can properly educate you as to how the program could benefit you or some of the drawbacks of the program relative to your individual situation. So it's really just, it's communication and education.
Number three. What are the benefits of assuming a mortgage?
You can get a great rate.
Especially
That's really
today.
it. Yeah, in a rising interest rate environment that we've been in for the past 3 years, the ability to assume a mortgage at historic lows can really keep that payment down for you.
Great. All right. How can I improve my chances of securing a favorable mortgage rate?
Two big things: credit grade and down payment. That's what steers the industry. So the bigger the down payment that you're putting down, likely the lower the interest rate you're going to pay. Same with credit. And I'll give you a quick example. So say you have an 800 credit score, which in the mortgage world, once you get over a 780 credit score, there's no grade higher than that as far as interest rates are concerned. But let's say that that individual is putting down 10%. And let's compare that against an individual who's got a 680 credit score, but they're putting down 50%. Who gets the better interest rate? The answer in that scenario is they're either going to receive the same rate, or I'm not looking at the pricing right now. Chances are that person with the 50% down payment may actually get a slightly better interest rate. Well, why? How is that fair? Well, it's skin in the game. When you look at the actuaries that do all these numbers behind the scenes, they're looking at risk all the time. So even if you have really great credit, if you're putting down 3%, 5%, 10%, that loan could be slightly more risky than the person with a lower credit grade that's putting down 50%, because that person has a ton of skin in the game, and the probability of any type of issue with that mortgage being paid or foreclosure isn't that.
That's great. Those were five great questions and five incredible answers. So thank you, Greg. And thank you for sharing your expertise on financing strategies, clarifying what's going on in the current market, and offering those three great creative finance strategies as well. I love having you on this show. You're absolutely fabulous.
Oh, my pleasure. Thanks so much for having me on the show, Athena. And I hope this is helpful for anyone out there that's watching or listening. And if you have any questions, reach out to Athena. If you have questions for me, reach out to Athena. She'll put you in touch with me and we'll do our best to educate you properly. I know it's redundant, but education is the key to everything. Understand what you can and what you can't do and make the best decision for yourself.
I love those final thoughts. Thank you. And thank you to our listeners for tuning in to Ask Athena Anything. If you have questions or like to book an appointment, all of our information is going to be in the description below. Remember to subscribe. Happy house hunting and see you next time.